Hi, this is Jack Crooks from Money and Markets TV. Up until last week, the consensus among many analysts was that the rally in gold would continue without a hitch. A rise to $2,000 an ounce was a slam dunk, and the dollar was going into the tank. But then reality intervened. Now gold is trading closer to $1,600 an ounce, and the dollar is on its way up. This change in direction seems due to the need for liquidity, and I believe it indicates that we've just seen a multi-year bottom for the U.S. currency. And increasingly, the evidence suggests it may be time to consider taking some profits in gold, or at least protecting the downside with a stop-loss order. In order to illustrate my point, I want to show you several charts comparing the relationship between stocks and commodities, and ultimately the dollar. The first is the Dow Jones Industrial Average versus the gold-silver ratio. As you can see, the lines move inversely to one another. The peaks in the Dow correspond to troughs in the gold-silver ratio and vice versa. In other words, when investors are buying growth stocks and growth assets, they tend to favor silver over gold because of silver's heavy use in industrial applications and increased demand when the economy is growing. But what's interesting is that gold eventually follows the stock market lower, usually about 5 months after the Dow hits its peak. This makes sense when you think about it. Once stocks start to go down, the hedge fund managers get margin calls and must make up for their bad trades. They do this by raising cash from the winning side of their portfolio, in this case, gold. This is exactly what we saw last week, and if history is any guide, both gold and stocks should continue to head lower. So if equities and commodities have both topped out, the next question is why? The answer becomes clear if we chart the Federal Reserve's 2 rounds of quantitative easing. As you can see, both asset buying programs boosted stocks, and when they ended, the market reacted dramatically. The same goes for natural resources, as a chart of the CRB Commodities Index shows. QE2 coincided with a huge run-up in these assets, especially gold. And according to my technical indicators, now that QE2 is over, the CRB is facing a retracement of more than 60%. So given this shift out of risk assets, where's the best place for you as an investor to find safety, besides short-term U.S. Treasuries? Well, how about the dollar? As I said last week, this trend toward liquidity represents a real and substantial move into the U.S. currency, and I believe the dollar has a lot more upside potential. So if you own a bunch of gold or you're heavily short the dollar, I'd say it's time to seriously reconsider your position. I'm Jack Crooks from Money and Markets TV. Thanks for watching.